So, as many of you know, we're in a pretty unique situation in the world of capital markets and commercial real estate. There is much lower demand for office space than there has been in a really long time, and it's impacting building valuations. When you hear transactions occurring, one of the common kind of pieces of jargon you'll hear talked about is NOI or net operating income. Net operating income is the revenues of a project minus the expenses. So if you take the rents and other income, you subtract out just the operating expense, not the capital expenses, and not the debt service or what it costs to pay off the mortgage on a property, you get net operating income or NOI. And NOI is really kind of like the lifeblood of any transaction. When an investor is buying a building, really what they're paying for is not the sticks and bricks, not the physical structure. They're buying future net operating income, right? So it's an investment. They're looking at the project as a source of paying back their investment. And the way we can tell that that's true is in the market today where there's really low demand for office and future outlooks for office rentals are quite low, you're actually seeing buildings trade at very low valuations, right? Because if the NOI, the net operating income, isn't there, if leases aren't signed, if rents aren't going up over time, and there's a lot of vacancy, why would an investor pay much for that building when it's not supplying much net operating income? And so you're actually seeing not only are these buildings trading far below their previous values, they're trading below replacement costs or construction costs. So if you took a building and said, I'm going to rebuild it today, the exact same design, the exact same location, the exact same everything, the replacement cost, the cost of you to rebuild it today is going to be much higher for a typical office building than the current value. And that's because, again, you're not paying for the steel and concrete, you're paying for the net operating income. And people don't believe that if you build an identical building, it'll get leased up, just like the existing one is having a hard time getting leased up. So again, that is how net operating income is connected to value, and it kind of proves that an investor really isn't paying for the building. They're paying for the future net operating income that that building is going to provide. They're not paying for the sticks and bricks. So it's just an interesting way to think about how those two things are connected and how you're not really buying what people think you might be buying when you're talking about a real estate investment.